Welcome to Wealth Hustle 247 podcast, your trusted guide to financial literacy, business innovation, and entrepreneurial success. Learn how to grow your wealth, make informed decisions, and turn your ideas into profitable ventures.
Take control of your financial future. In this AI-generated overview of Mastering Investment Terms, your guide to smart financial decisions, learn the essential terminology and strategies that empower you to make informed, confident investment choices. Unlock the knowledge to make smart decisions, grow your wealth, and secure a brighter tomorrow. Your path to financial success starts with understanding. Let's master it together.
Hey everyone, welcome back. Today we're diving deep into the language of investing. You know, all those terms they just throw around like everyone's supposed to know what they mean.
Right.
Yeah, exactly. So we're going to try to demystify all that today.
Absolutely.
We've got this awesome guide called Mastering Investment Terms, and we're going to break it down plain and simple so you can walk into any financial conversation feeling like a pro.
Like you've got this.
Exactly.
It's like having that secret decoder ring for Wall Street.
I love it.
You know, once you understand the lingo, the whole world of investing opens up.
It does. It's true. All right. So let's see. This guide, it's got a ton of terms. Asset allocation, bonds, capital gains, dividends. I mean, where do we even start?
Well, just like building a house, you got to start with the foundation, right?
Yeah.
In investing, that foundation, that's asset allocation.
Okay. So asset allocation, is that just a fancy way of saying don't put all your eggs in one basket?
Well, that's part of it. It's about strategically dividing your investments across different asset classes. You know, stocks, bonds, real estate, maybe even a little gold.
Ooh, cool.
Yeah, it helps manage risk.
Okay, so it's not just about playing it safe then. It's about maximizing your potential gains too.
Exactly.
All right. I'm intrigued. Tell me more about these different asset classes. What are bonds all about?
Okay, so think of bonds as loans,
Okay.
but you're the lender. So you loan money to a government or a company, and they promise to pay you back with interest. It's considered a lower risk investment, especially compared to, say, stocks.
Okay, so bonds are like the reliable friend who always pays you back.
Exactly.
Okay. What about stocks? They seem a bit more unpredictable.
Yeah, a bit more,
Historically.
well, stocks are a piece of ownership in a company, so when that company does well, your stock value, that goes up.
Okay.
But when they struggle, your stock might lose value.
Makes sense.
So higher returns, but yeah, more risk comes along with that.
So if bonds are the steady friend, stocks are more like that friend who's always starting some new business venture. Exciting, but maybe a little nerve-wracking.
Yeah, that's a great way to put it. All right, so now let's talk about how you actually make money from stocks. There are two main ways: capital gains and dividends.
All right, break it down. What's the difference between a capital gain and a dividend?
Okay, so capital gain, that's simply the profit you make when you sell something like a stock for more than you paid for it. Buy low, sell high. That's the basic idea.
Straightforward enough. What about dividends? How do those work?
Okay, so dividends, those are like little bonus payments. Some companies will pay these out to their shareholders.
Oh, okay.
It's a way for investors to share in the company's profits.
Interesting. So even if the stock's price isn't going up, you can still make money through dividends.
Yeah,
It's like getting paid just for owning a piece of the company.
exactly. Of course, not all companies pay dividends, and the amount can vary. But it's definitely something to consider when choosing stocks.
For sure. Okay, this is making me want to go play stock market simulator or something.
Yeah,
But I know there's a lot more to learn before I jump in with real money.
absolutely. And that brings us right back to diversification.
Hmm.
You don't want to put all your investment eggs in one basket, no matter how promising that basket looks.
Right, spread the risk. Got it. Okay, I'm starting to see why this is so important.
Yeah, balancing potential rewards with smart risk management. And that's where understanding all the different types of investment vehicles come in. Have you ever heard of ETFs and mutual funds?
I have, but to be honest, I'm not always sure what the difference is. They both sound kind of like baskets of different investments.
You're on the right track. Both ETFs, or exchange-traded funds, and mutual funds, they pool money from multiple investors to invest in, yeah, a diversified portfolio of assets.
Okay, so what makes them different? Is one riskier than the other?
Not necessarily. The key difference is in how they are managed and traded. ETFs are traded on stock exchanges, just like individual stocks. And their prices, they fluctuate throughout the day. They tend to have lower fees because they typically track a specific market index.
Got it.
Yeah.
So ETFs are kind of like the set it and forget it option. You buy them, and then they just follow the market.
Yeah, that's a common approach. But it's not the only one. There are also actively managed ETF, but most of them are passively managed. Now, mutual funds, on the other hand, they're typically actively managed by a professional fund manager.
So with mutual funds, you're basically trusting someone else to make investment decisions on your behalf.
Yes. And their goal is to outperform the market by, actively buying and selling securities within that fund. Of course, active management usually comes with higher fees.
Ah, so it's a trade-off potential for higher returns with mutual funds,
Yeah.
but you're paying for that expertise.
Exactly. Now, there's another type of fund you might have heard of, hedge funds. But these are a different beast altogether.
Hedge funds. Those always sound so mysterious and exclusive. Are they only for, like, the super rich?
They tend to be, yeah. Hedge funds are typically only open to what are called accredited investors. So individuals or institutions with a high net worth and a certain level of financial sophistication.
Okay, I see.
Yeah.
Why is that? Are they riskier than other investments?
Well, hedge funds use a wider range of investment strategies, often involving leverage and derivatives, trying to generate those high returns, regardless of whether the market is going up or down.
Okay, so they're playing a different game altogether. Probably not a game for beginners, right?
Definitely not. Hedge funds can be very complex and come with significant risks. So we'll stick to the basics for now.
Good idea. So speaking of things that can impact your investments, this guide also mentions inflation. I know that's an economic term, but how does it affect, like, my money?
Right. Well, inflation is basically the rising cost of goods and services over time. Imagine a loaf of bread that costs $2 today might cost $2.50 next year because of inflation. So your money literally buys you less over time.
That's a scary thought. So even if my investments are growing, inflation could be, like, eating away at those gains.
Exactly. That's why it's so important to invest in ways that can outpace inflation. If your investments aren't growing faster than the rate of inflation, you're actually losing purchasing power.
So we need our money to work hard to stay ahead of those rising prices.
Yeah.
Got it. What about IPOs?
Yes.
We hear about those all the time. Initial public offerings.
IPOs, yeah.
Are those worth looking into?
So an IPO, that's essentially a company's grand entrance into the stock market. It's the first time a private company offers shares of stock to the public.
Oh, so it's like getting in on the ground floor of
Exactly.
a potentially big opportunity.
Yeah, they can be exciting, but they also carry a lot of risk.
Yeah.
Just because a company is new and buzzworthy, it doesn't guarantee success.
Makes sense. It's like investing in a band before they make it big. Could be a huge payoff, or they might never take off.
Yeah, that's a great analogy. Speaking of getting your money back, let's talk about another important concept. Liquidity.
Okay, liquidity. I've heard that term, but I'm not sure I fully understand it. Does it mean like how much cash I have on hand?
No, not exactly. Liquidity refers to how easily you can convert an asset into cash without significantly impacting its price.
So how quickly and easily you can turn an investment back into cash.
Precisely. Some assets are highly liquid, like stocks, bonds. You can sell those almost instantly on the market.
Right.
Others, like real estate, they can take much longer to sell. You might not get the price you want.
So if I need access to my money quickly, I'd want to stick with more liquid assets.
That's a smart strategy. It's always important to consider liquidity, especially if you might need to access your funds for, unexpected expenses.
This is all starting to make so much more sense. What else do we need to know to, like, really crack the code of investing lingo?
Well, there's one more term I want to cover before we move on. Market capitalization.
Okay, market cap. That one sounds a little intimidating.
It's actually pretty simple. Market capitalization, or market cap, just refers to the total value of a company's outstanding shares of stock.
So it's like a measure of the company's overall size in the stock market.
Exactly.
A big company would have a larger market cap than a small company?
You got it. And investors often use market cap to categorize companies: small cap, mid cap, and large cap. These categories can give you some insight into a company's growth potential and risk.
So is it fair to say that smaller companies with smaller market caps might have more room to grow but might also be riskier?
That's a good general rule of thumb. Of course, there are always exceptions, but generally speaking, small cap companies, they're considered to have higher growth potential. But yeah, also higher risk, while large cap companies tend to be more established and stable.
Okay, that makes sense. So are there any, like, specific examples of small cap, mid cap, and large cap companies that, our listeners might recognize?
Sure, a good example of a large cap company that everyone knows is Apple. I mean, their market cap is enormous, reflecting their, size and influence in the market.
Sure.
A mid-cap example might be a company like DocuSign.
Uh-huh.
And a small-cap company could be a newer tech startup that's, just starting to gain traction.
That helps paint a clearer picture. So we've got small companies with potential but more risk, and then the big established players who are maybe a bit more predictable.
Right.
It's like choosing between a promising startup and a blue chip stock.
That's a good way to think about it. Now let's shift gears a bit and talk about a type of investment that can be used in many different ways. Options.
Options, okay. Those always sound a bit mysterious.
Yeah.
Are they like bets on the stock market?
In a way, yes. Options are contracts that give you the right but not the obligation
Okay.
to buy or sell an asset at a predetermined price before a specific date.
So it's like having the option to buy a concert ticket at a certain price. And if the band gets really popular and the price goes up, you can still buy it at that lower price you locked in. But if they flop and the price goes down, you could just choose not to buy it.
That's a fantastic analogy. You clearly have a knack for this.
Yeah.
Options can be used for many different strategies, like hedging against potential losses or speculating on future price movements.
Sounds like they require a bit more expertise to navigate than just buying and selling stocks.
Yeah, you're right. Options trading can be quite complex and risky. It's not something to just jump into without a solid understanding of how they work.
Duly noted. So we've talked about all these different investments: stocks, bonds, ETFs, mutual funds.
Yeah.
How do we put it all together? What is a portfolio exactly?
Think of your portfolio as your investment collection. Each investment you make is like adding a new piece to that collection.
So it's not just about picking individual investments. It's about building a collection that reflects, like, my goals and risk tolerance. Like building an art collection, but with stocks and bonds.
That's a great way to think about it. A well-constructed portfolio, it should be diversified. It should be aligned with your risk tolerance and designed to help you achieve your financial goals.
Okay, so we've got a portfolio that's hopefully growing. How do we actually measure, like, the success of our investments?
That's where return on investment, or ROI, comes in. ROI is simply a way to measure how much your investments are earning. It's calculated by dividing the profit you made from an investment by the initial cost of that investment.
Okay, so if I invest $100 and make $20 in profit, my ROI would be 20%.
Exactly. It's a quick and easy way to compare the performance of different investments.
Okay.
But remember, ROI, it's just one piece of the puzzle. You also need to consider factors like risk and time horizon.
Right, because a high ROI might come with high risk, which isn't always a good trade-off. And speaking of risk, this guide also emphasizes the importance of understanding your risk tolerance.
Oh.
Why is this concept so crucial?
Risk tolerance is all about your personal comfort level with investment ups and downs.
Okay.
Some people, they're thrill seekers. They enjoy the excitement of a volatile market.
Right.
Others prefer a smoother ride, a more predictable ride.
So it's like choosing a roller coaster. Some love the adrenaline rush, others prefer the Ferris wheel. How do I figure out my own risk tolerance? Is there like a test I could take or something?
Well, there are definitely quizzes and questionnaires available online, but ultimately it's a matter of self-reflection.
So what are some good questions to ask myself to figure out my own risk tolerance?
Ask yourself, how would you react in different market scenarios? Imagine your investment suddenly dropped 10%. Would you panic and sell everything? Or would you see it as a buying opportunity?
I think I'd probably fall somewhere in between. Definitely some anxiety, but also a little bit of, okay, maybe this is a chance to buy low.
That's a very normal reaction.
Yeah.
The key is to be honest with yourself about how you'd react in different situations. If you tend to be more risk-averse, you might want to lean towards a more conservative portfolio.
So more bonds, less stocks.
That could be one approach. It's all about finding the right mix that aligns with your comfort level. Another factor to consider is your time horizon. If you're investing for a long-term goal like retirement, you might be more comfortable with a higher level of risk.
Because you have more time to recover from any potential losses?
Exactly. But if you need access to your money in the near future, you might want to opt for a more conservative approach to minimize the risk of short-term fluctuations.
This is all starting to connect. Time horizon, risk tolerance, diversification. These are all pieces of the puzzle that fit together.
You're getting it. And remember, there's no shame in seeking professional guidance if you're feeling overwhelmed or unsure. A financial advisor can help you create a personalized plan that aligns with your individual needs and goals.
Like having a financial coach in your corner,
Exactly.
helping you navigate all the complexities.
Absolutely.
All right. Well, we've covered a lot of ground here, from asset allocation to risk tolerance. What else do we need to know to feel like we've truly mastered these investment terms?
Well, let's talk about the different types of securities. That's the broad term for tradable financial assets.
Okay, securities. So we're talking about like stocks and bonds, that sort of thing. What else falls under that umbrella?
The three main types of securities are equity, stocks, debt, bonds, and derivatives, options and futures.
Okay.
We've already covered stocks and bonds pretty extensively, so let's touch briefly on derivatives.
Derivatives. Those always sounded a bit complicated. We talked about options earlier, right?
Yeah, options are a type of derivative. Derivatives are financial instruments that derive their value from an underlying asset, like a stock or a commodity. They can be used for hedging, speculation, and other more advanced investment strategies.
So they're like financial tools for more sophisticated investors.
That's a good way to think about it. Derivatives can be very powerful, but they also carry a lot of risk. They require a deeper understanding of financial markets.
We'll add that to the advanced investing list for later.
Yeah,
For now, let's stick to the basics.
sounds good. Now, let's not forget about another important concept that's often associated with risk: volatility.
Ah, yes, volatility. I always hear about market volatility, but what does it actually mean?
Volatility refers to the degree of fluctuation in the price of an asset or a market. Think of it like ocean waves.
Okay.
Some are calm and gentle, while others are wild and unpredictable.
So a volatile market is one that goes up and down a lot, like a roller coaster ride.
Exactly. High volatility generally means higher risk, but it can also lead to higher potential returns.
So it's another one of those trade-offs we need to consider.
Absolutely. Every investment decision involves weighing potential rewards against potential risks. And that brings us to the concept of wealth management.
Wealth management. That sounds like something for millionaires. Is this relevant to us regular folks?
Wealth management is relevant to anyone who wants to take a holistic approach to managing their finances.
Okay.
It's not just about investing, it's about creating a comprehensive plan to achieve your financial goals, whatever those may be.
So it's about looking at the big picture.
Exactly. Wealth management, it encompasses everything from budgeting and debt management to retirement planning and estate planning.
So it's like having a personal financial coach
Yeah.
who helps you create a roadmap for your financial future.
That's a great way to put it. A good wealth manager can help you define your goals, assess your risk tolerance, create a customized plan, and guide you along the way.
That sounds incredibly helpful. I'm starting to see how understanding all these investment terms can really empower us to take control of our finances.
Be a brighter future.
Knowledge is power, especially when it comes to your money.
This has been such an enlightening deep dive. I feel like I've learned so much already.
Great.
And we've only just begun to scratch the surface.
I know, right?
So much more to uncover.
There is.
But I feel much more equipped to navigate this world now.
I'm glad to hear that. That's what this is all about, giving you the knowledge and confidence to make those smart financial decisions.
Now, before we move on to the next section, I'd love to hear from you, dear listener. Which of these terms has sparked your interest the most? What are you most curious to learn more about?
That's a great question. What aspect of investing is calling out to you right now?
Okay, I'm definitely feeling more confident about those core terms, but I know there's always more to learn. Let's unpack some of these concepts a little further.
Yeah.
What are some of the common misconceptions or things people often miss?
Yeah, it's true. Sometimes the lingo itself can be misleading, like take market capitalization, for example.
It's often seen as like synonymous with a company's worth.
Right.
But that's not the whole story.
So a company with a huge market cap isn't automatically a great investment.
Not necessarily. Market cap, it only tells us the total value of all the outstanding shares. It doesn't factor in things like debt, future earnings potential, or even how innovative a company is.
Interesting. So a small, nimble company with a lower market cap might actually be a better investment than a huge, lumbering giant.
It's certainly possible. It all depends on your investment strategy and the individual company's fundamentals. Market cap is just one data point among many.
Don't judge a company solely by its market cap. Got it. What about some of those other terms we discussed? Any hidden depth there?
Definitely. Let's revisit liquidity.
Okay.
We talked about how easily an asset can be converted to cash, but there's also this concept of market liquidity, which is how much buying and selling activity there is for a particular asset.
So even if something is like theoretically easy to sell, it doesn't necessarily mean there are buyers lining up to buy it.
Exactly. Imagine trying to sell a rare antique.
Okay.
It might be valuable, but if there are only a few collectors who are interested, it could take a long time to find a buyer at the price you want. And the same principle can apply to certain stocks or bonds.
So liquidity isn't just about speed, it's also about finding a willing buyer
Yes.
at a fair price.
Precisely. And that's something to consider when choosing investments, especially if you might need to access your funds quickly. Now, another concept that often causes confusion is the difference between saving and investing.
Oh, yeah. Aren't they basically the same thing, putting money aside for the future?
Not quite. Saving, that's typically short term, and it focuses on preserving capital. Think of your emergency fund or the money you're setting aside for a down payment on a house. You want that money to be safe and accessible.
Makes sense.
Investing, on the other hand, is about putting your money to work
No.
with the goal of growing it over the long term.
So saving is like parking your money in a safe place,
Yes,
while investing is more like sending it out on a mission to earn more money.
I like that analogy. And just like any mission, investing involves risk.
Right.
But with careful planning and diversification, you can manage that risk and potentially reap significant rewards.
Okay, that makes sense.
Yeah.
And it ties back to something we talked about earlier,
Yeah.
having a clear investment strategy.
Exactly. It's not just about throwing darts at a board and hoping for the best. You need to define your goals,
Right.
assess your risk tolerance, and choose investments that align with your overall financial plan.
And it's okay to ask for help along the way.
Absolutely. A financial advisor can be an invaluable resource, especially if you're new to investing or feeling overwhelmed by the sheer number of choices out there. They can help you create a personalized roadmap and navigate all those complexities of the financial world.
So we've got our goals, we've assessed our risk tolerance, and we're starting to build our portfolio.
Hmm.
But the world of investing is constantly changing, right? How do we stay on top of things and make sure our investments are still on track?
That's where the concept of rebalancing comes in. Remember how we talked about asset allocation?
Yeah.
Well, over time, the value of your different asset classes, it'll fluctuate. And your portfolio, it might drift away from your original target allocation.
So if my stocks perform really well, my portfolio might become too heavily weighted towards stocks,
Exactly.
even though I originally wanted a more balanced approach.
Exactly. Rebalancing is the process of bringing your portfolio back in line with your desired asset allocation. It might involve selling some of your winners
Okay.
and buying more of your laggards to restore that balance.
Interesting. So it's not just about buying and holding, it's about actively managing your portfolio over time.
Precisely. And that's something you can do yourself, or you can work with a financial advisor to create a rebalancing strategy that meets your needs.
Okay, that makes sense. But what about all those external factors that can impact the market, like inflation or interest rate changes? How do we account for all those unpredictable things?
That's where staying informed and adaptable comes in. It's important to keep up with market trends and, economic news, but don't get too caught up in the day-to-day noise. Remember, investing is a long-term game.
So don't panic and sell everything when the market takes a dip.
Exactly. Short-term fluctuations are normal. It's the long-term trends that matter the most.
Okay.
And if you're diversified and you're following a well-thought-out plan, you'll be better positioned to weather those storms.
This is all starting to feel a lot less intimidating and a lot more empowering.
That's the goal. Knowledge is power, especially when it comes to your finances.
Now, before we move on to the last part of our deep dive, I want to circle back to something you mentioned earlier, the psychological aspects of investing.
Ah, yes. The human factor.
Yeah.
That can often be the biggest obstacle to investment success.
So it's not just about understanding the numbers and strategies.
Right.
It's also about understanding ourselves and how we react to different situations.
Exactly. Our emotions can lead us to make irrational decisions, like selling low out of fear or chasing after those risky investments out of greed.
I've definitely been guilty of that. So how do we keep our emotions in check and avoid making those kinds of mistakes?
One helpful strategy is to create a written investment plan and stick to it.
Okay.
Outline your goals, your risk tolerance, your investment strategy. That way, when the market inevitably throws you a curveball, you have a roadmap to guide you.
It's like having a prenup for your portfolio.
Yes,
Something to refer back to when things get heated.
I love that analogy. It's about creating a framework
Right.
that helps you stay rational,
Yeah.
disciplined, even when your emotions are telling you to do something else. Another key is to focus on the long term.
Okay.
Don't get caught up in the day-to-day noise of the market. Remember, investing is a marathon, not a sprint.
So tune out the noise, Stay focused on your goals.
Exactly. Short-term fluctuations are normal. It's the long-term trends that matter most. And if you're diversified and you're following a well-thought-out plan, you'll be better positioned to weather those storms.
This is all making me feel so much more confident about navigating the world of investing. But I know there's always more to learn. What else should we keep in mind as we continue on our investment journey?
One thing to remember is that the financial landscape, it's constantly evolving. New investment products and strategies are emerging all the time. It's important to stay curious, keep learning, and be open to adapting your approach as needed.
So don't be afraid to ask questions, seek out new information, challenge our own assumptions.
Exactly. The more you learn, the more empowered you'll become as an investor.
This has been such an insightful deep dive into the nuances of investing. I feel like we've peeled back another layer of the onion and gained a much deeper understanding of these key concepts.
I'm glad to hear that. Remember, knowledge is power, especially when it comes to your finances.
Now, before we move on to the final part of our deep dive, I want to challenge our listeners to think about their own investment journeys.
Yeah.
What's one area where you feel you could improve your understanding or your approach?
What's one question you've always wanted to ask about investing but haven't had the chance?
Take a moment to reflect and identify one area where you can take a step forward on your path to financial empowerment. We've talked about so much, risk tolerance, diversification, all these different investment vehicles. But how do we bring it all together? How do we actually build a portfolio that aligns with our goals, our risk appetite? What does that actually look like?
Right. That's the million-dollar question, isn't it?
It is.
Building a well-structured portfolio, it's like crafting a work of art.
I like that.
Requires careful consideration, balance, a deep understanding of your own financial landscape.
So where do we even begin?
Well, the first step is always define your financial goals. What are you saving for?
Yeah, that makes sense.
Retirement, down payment on a house, your children's education. Once you have a clear vision of those goals, then you can start mapping out a plan to actually achieve them.
Right, because if I'm saving for retirement, 30 years from now, my investment strategy is probably going to look different than someone who needs the money in 5 years.
Exactly. Time horizon is a crucial factor in determining your asset allocation. If you've got a long time horizon, you might be more comfortable with a higher allocation to stocks, which have historically offered higher returns over the long term, but they also come with more risk.
But if I need the money sooner, I might want to play it a bit safer with more bonds in my portfolio.
Yeah, that's a prudent approach. The next step is to honestly assess your risk tolerance. How comfortable are you with those market fluctuations? How much potential loss are you willing to, stomach?
Right. And we talked about visualizing different market scenarios earlier. That's a great way to kind of gauge your emotional response.
Right. Exactly. It's important to be realistic about your risk tolerance. If you're constantly stressed about your investments, it might be a sign that you're taking on too much risk.
Yeah. And that stress can lead to impulsive decisions, which can really hurt your returns in the long run.
Exactly. Once you have a clear understanding of your goals, your time horizon, and your risk tolerance, you can start to build that diversified portfolio that aligns with your, unique financial profile.
So how do we actually go about choosing specific investments? Because there are so many options out there. It can feel pretty overwhelming.
It can, yeah. That's where research and due diligence come in. Don't just blindly invest in a stock because you heard a tip from a friend or saw a flashy ad.
So no chasing after the latest hot stock tip.
Definitely not. Take the time to really learn about the companies that you're considering investing in. Look at their financials, their management team, their competitive landscape.
It's like doing your homework before you make any big decision.
Exactly. And remember, diversification is key. Don't put all your eggs in one basket, even if it's a basket you really, really believe in.
Right. Spread the risk, balance your portfolio, and I guess don't be afraid to ask for help if you need it.
Those are great takeaways. And don't forget the importance of regularly reviewing and rebalancing your portfolio as your circumstances change.
Oh, so it's not a set it and forget it kind of thing.
Definitely not. Your financial goals, your risk tolerance, market conditions, those can all change over time,
Right.
It's important to stay engaged and make adjustments as needed.
This is making me feel so much more informed and empowered about managing my own investments. But I have to admit, it can still feel a bit intimidating to go it alone.
I understand. And that's where seeking professional guidance can be so helpful. You know, a financial advisor can provide that personalized advice, help you navigate those complex financial decisions, and keep you on track to achieve your goals.
It's like having a trusted guide, for your financial journey.
Exactly. They can help you avoid those costly mistakes, help you make the most of your investments, and ensure that you're making decisions that are truly in your best interest.
Okay, so if you're feeling overwhelmed or unsure, don't hesitate to reach out to a qualified financial advisor.
Yeah.
They can be an invaluable resource on that path to financial well-being.
Absolutely. Now, as we kind of wrap up this deep dive into the world of investing, I want to leave you with one final thought.
Okay.
Investing is a journey. It's not a destination. It's about making those informed decisions, staying disciplined, constantly learning and adapting.
And remember, even small, consistent steps, those can lead to significant progress over time.
Exactly. The most important thing is to start today, no matter how small that step may seem.
Amazing. Well, thank you so much for joining us on this adventure of, financial discovery. We hope you've gained some valuable insights. We hope you feel inspired to take control of your financial future. And until next time, happy investing.
That's it for today's episode of Wealth Hustle 247. Be sure to follow, like, comment, and share with others. Keep pushing toward your goals, and we'll see you in the next episode.